Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, and thank you for joining us today. My name is Abhilash, and I'm a senior investment strategist at Standard Chartered Bank. We are recording this on 11th of February, and we have just released our weekly market view titled From the Rat to the Ox as we transition into the new lunar year. Now, ox is a symbol of hard work and positivity, and perhaps few symbolisms better reflect the unfolding economic and financial landscape. For investors, 2021 is when the hard work of policymakers in lifting global economy from one of the deepest recessions pays off. However, as investors remain optimistic about ongoing vaccinations, equity markets have broken into new record highs, and high-yield bond market yields have touched new lows. Naturally, this raises the question whether the markets have already priced in the good news, leaving little scope for negative surprises. To discuss these and what this could mean for investors, on today's podcast, I have with me Audrey Go, Senior Cross-Asset Strategist, and Fook Senior Investment Strategist. So let's start with Fook. Now, we have seen U.S. stocks touch new record high earlier this week following earnings season, and as reflation theme has re-emerged. What are the sectors that we are focused on?
Yeah, thanks, Abhilash. As you say, a reflation theme is emerging as the interest rate markets are pointing towards a higher inflation expectations now. And this is consistent with the strong monetary stimulus that we have, which is driving a cyclical recovery after we had a very sharp recession last year. So as the recovery continues with policy support and the vaccine rollout, the sectors that have been hit the hardest in the cyclical downturn, these can be expected to bounce hard in the cyclical recovery. So we have a preferred view on the industrials, consumer discretionary, and material sectors in the U.S. These three sectors had sharp declines in 2020, and these sectors will also have the strongest earnings rebound expected for 2021. We have a chart in our weekly market view that shows that. You can refer to that. In the chart, though, you'll see that energy sector is actually expected to have the strongest earnings rebound after a terrible 2020. And the sector now is not on our preferred list because it faces headwinds as the investors and government policy is pivoting towards green investments. Now, also with inflation, we are seeing a steeper yield curve, and that's seen in the market now, and this is a positive driver for the financial sector. As the sector now, the banks can earn higher net interest margins on future loans. So yes, financials are also a preferred sector for us. And the other three are industrials, consumer discretionary, and materials for your cyclical exposure.
Thank you, Ken. Now, moving over to Asia, we have seen Asian equities get off to a great start in 2021, led by China. Now, what is the focus for China and Hong Kong equities after the Lunar New Year holidays?
Yeah, so the China and Hong Kong earnings season will kick off in March, and so earnings will really be the focus after the Lunar New Year. We get pre-announcements of results in the region, and so far, the net positive alert suggests a solid V-shaped earnings recovery. The market is expecting 12-month forward EPS or earnings growth of 18% for China equities. Now, a strong Q1 result will support this growth, and it could even lead to upward earnings revision and a potential re-rating in the valuation. On the sector level, healthcare and technology have pre-announced the biggest earnings rate so far. So for us, China equities, both onshore and offshore, are preferred markets with the economic recovery, a stronger CNY, and accommodative government policies. China onshore has more cyclical exposure and is less impacted by geopolitical tensions, while China offshore has many large internet stocks, and these may face regulatory risk. Among the sectors, healthcare and technology are preferred sectors for us, a strong earnings outlook there. And consumer discretionary is also preferred for us with a strong domestic consumption growth.
Thank you, Fook. Now, the other big news this week was that U.S. high-yield bond markets touched new lows in terms of yields. Now, Audrey, from your perspective, should investors worry about the record low yields in U.S. high-yield bonds?
Thank you, Abhilash. Well, yields on U.S. high yield fell below 4% for the first time ever, and that's driven by ongoing economic recovery, strong U.S. earnings season, and certainly ample of liquidity, which continue to fuel investors' search for yield. Well, there are some signs of frothiness, especially in the CCC rated space. The expected default rate could well continue to support investors' optimism in our view. Risk reward on U.S. high yield has reduced, but that said, we continue to view them favorably as compared to investment grade or even the government bonds, which are trading at even lower yields. For investors seeking higher income, he or she can consider Asian high yield bonds, which present an attractive alternative as a yield pickup, and also the absolute yield offered by Asian high yield bonds over the U.S. counterpart is substantially higher than the historical average.
Thank you, Audrey. Now, you did mention towards the end that Asian high yield bonds look attractive on a relative basis. However, we have seen some defaults in Chinese high yield property sector recently. Are we concerned about the default risk there?
Well, there was one default by a China real estate company, which negatively impacted the China high yield property bond space, basically triggering a rise in default concerns. Despite that, we do believe that authorities are unlikely to ease regulatory measures, as the PBOC, which is the central bank in China, stated in their fourth quarter 2020 monetary report that they will continue to focus on continuity, consistency, and stability for the property sector. Therefore, refinancing risk will likely continue to remain an ongoing concern for companies in the China high yield property sector. That also means that the market will increasingly differentiate quality on the basis of debt sustainability. But that said, the recent volatility was largely triggered by and also has been thus far limited to just one single individual default event. Therefore, the China high yield property bond negative impact at the moment is likely to be temporary, especially in the high yield subcategory. This basically gives us comfort in our preference for Asian high yield bonds, of which the China high yield property sector is a significant component of. And we would be comfortable to take advantage of this pullback to add exposure where appropriate.
Thank you, Audrey. Now, last but not the least, moving on to currencies, we have seen US dollar strengthen over the past few weeks. But do we think that the US dollar bounce is over now?
Well, the short-term rally that we expected in the US dollar since sometime in mid-January has largely materialized. But if you look at the rebound, it has been fairly modest. And this price action basically supports our 12-month bearish stance on the US dollar, as investors appear to be looking through the possible near-term US economic outperformances from the stimulus and faster vaccination, and focusing on the likely downside risk on the US dollar over the longer term, which includes inflationary pressure as well as larger budget and trade deficits. We continue to believe that it makes sense for investors to average into our preferred currencies, including euro, Aussie dollar, as well as pound. In the case of euro, a key support at around 1.1950 would offer a good initial entry point. And in the case of Aussie US dollar, the January highs of 0.7820 remains unbroken. But that said, we believe that there could be opportunity to enter around 0.7560. Now, finally, in the case of pound, this pair, pound US dollar, has rallied quite strongly with relatively minor corrections so far. Hence, we will look for another dip, potentially around or towards 1.3570 level as an initial entry.
Thank you, Audrey, and thank you, Fook, for taking part into his discussion. And thank you all for listening into today's podcast. Please stay safe and do reach out to your relationship manager or check the Standard Chartered Private Bank app if you would like a copy of our weekly market view report. Thank you.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.